Morning, welcome to April's Fireside chat. Chris can't make it today, but Jaden is with us instead from Genium. How are you, Jaden?
Good, Clint. Good to be here.
Very good. Obviously, this last month has been a little bit of turmoil in the markets and commodities, so might just hand over to Jaden to give us a bit of a rundown on what he's been seeing over this last month and the effects that he's seeing on the markets.
Yep, so last month's been overwhelmingly driven by the war in Iran, rhetoric around the war in Iran, and markets trying to extrapolate the duration of the conflict and what the impacts will be. So the way we've broken this down, there's three stages to a conflict like this. Stage one, which is what's happened through the last 4 weeks, you get a big spike in the VIX and a sell-off across markets, equity markets broadly. So most markets have moved in tandem. Most were down, peak to trough around 10% for the month of March. There's going to be some slight impacts. Emerging markets, higher beta markets will be down slightly more, but it's broadly been around that low double digits mark. As we move past that stage one into stage two, the market tries to discern the impacts across different economies and sectors, and that's what we've started to see in the last week. So countries with most specifically their own oil supply or own refining capacity are going to be much better off over the forward period than countries without their own oil and refining capacity, where Australia obviously locally has gotten a lot of attention. And then stage three, after about 6 months, if this continues for that long, which is not our base case, but if we were to see that and it becomes a more prolonged war environment, which is like what we've had in Russia, Ukraine, then the impacts become broader but also more localized to Asia. So Asia being closest in proximity to the Middle East and most reliant on Middle East exports of oil, but also gas as well. That's where we see the biggest impact. So in the last month, the VIX and the MOVE index, so MOVE is the bond version of the VIX, both spiked, but nowhere near as much as Liberation Day levels. So Liberation Day, go back 12 months when Trump put through that massive increase in tariffs, the VIX spiked to 45. This time the VIX spiked to 30 and then trailed back off throughout the month. So volatility, although it feels high given the news flow and the news cycle, has stayed fairly muted, probably more muted than we would have expected if you gave us this scenario 6 months ago and said this is what was going to play out, this is what Trump's going to tweet. We'd probably be a little bit more, we'd probably expect a much bigger move in the VIX, and that just hasn't happened. And then in credit markets, spreads have widened, but only half as much as what happened on Liberation Day. So again, quite a muted response, especially given how tight credit spreads are today relative to history. So markets remain expensive, credit spreads remain very tight, but there's again another set of reasons for them to widen, which we think presents risks. So it's important to be very selective, very active within credit. Over the last month, so the story at the start of the month when the Strait of Hormuz first closed, it was going to be a 20% hit to global supply. For the first few weeks, that was only about 5% of global supply. It depends on whose estimate you look, but both BCA Research and JP Morgan have that first month impact, or first 3 weeks specifically, only being about 5% of global supply. So that's been dampened by the biggest International Energy Agency reserve release in history, which was in the second week of the conflict, rerouting of oil through the Red Sea, but also China-linked supply or Iran ally-linked supply being able to come through the Strait. So that's been positive for global supply in the short term, but now that IEA reserve release has rolled off, that supply impact is about 10-12% today. So not the 20% that gets all the headlines, but still very, very high and in line with the biggest shock we've had in history. So the physical impacts are starting now, and the supply jump is high now as well. Other impacts which have been quite well reported, and LNG prices are up. 20% of the world's LNG production flows through the Strait, but overwhelmingly most of that goes to the Middle East. So only 3% of the world's global consumption of LNG comes through that Strait. But LNG is priced to the margin. So there's no supply problem for LNG for most countries around the world, but because LNG is priced to the margin, we've seen the LNG price spike. Fertilizer prices have spiked, and urea prices, which are used by farmers to increase the yield of their crop, have really ramped up as well. Helium prices have also spiked over 100%. Helium's a byproduct in LNG production and is used heavily for semiconductor manufacturing. So if that price spike remains high and helium remains elevated, chip prices are going to go up pretty quickly. So all of these impacts that we're talking through, the economic impact, they're all inflationary. This clearly puts pressure on interest rates over the near term, probably looking 12 months out, but we're likely to have, even if this conflict ends tomorrow, a pretty meaningful inflation shock over the next 6 months, but that impact will separate across countries, which I'll talk to in a second. The other thing, the positive to this, I suppose, is that the energy intensity of oil relative to GDP is much lower than it was previously. So GDP is much less sensitive to oil prices than it was 10, 20, 30 years ago. Even gas, in the last 30 years, our gas usage has doubled, but the energy intensity of GDP for gas has halved because we're using these materials much more efficiently than we have previously. So if you try and look back through history and say this is the last time we had a 10% oil supply shock, the economic impact could be smaller today based on that relationship between oil price and GDP. It's much looser than it used to be. Now, as the conflict diverges and we enter in stage 2, the economic impact across countries, we're starting to see what that looks like. So the US is one of the only major economies in the world that's a net exporter of oil. So because of that, they're in a pretty attractive position in that they have all the supply they need. They have more supply than they need domestically. So that's a good thing for US oil producers. And we're also seeing that in inflation expectations. So if you look at break-even inflation rates across different geographies, the US break-even inflation rate, looking at 1 year, has not moved. So markets are not pricing for any inflation spike in the US. But if you look across Europe, the UK, Australia, we're seeing a big spike in break-even inflation rates because we're much more dependent on imported sources of supply. So that really starts to separate out the economic outcomes and might be one of the reasons that the US is more confident going into this conflict than some other countries who aren't willing to join the conflict at risk of further extending it. Market forward curve for oil price has it coming off pretty aggressively later this year. So that's the positive. Markets are looking through this and saying, we think this is going to end pretty quickly, oil supply is going to come back up, and the oil price would drop. Not to pre-conflict levels, but higher than they were previously. So this is rare in history. So if you look at the last 10 oil shocks since 1970, only 4 times has the oil price finished, 12 months after the conflict started, finished lower than it started. So it's rare for the oil price to come back to anywhere near where the shock price was 12 months after. It doesn't mean it's impossible, it's just worth being aware that it's rare. Australia specifically, we get asked about this a lot. A lot of end clients are probably asking or starting to ask advisors about what the impacts for Australia are. We're fortunate in that we're a very rich country and that we export a lot of other energy sources like gas to the countries we import our refined supply from. So we're able to buy ships at spot prices that were intended for other countries, but we can now bring here. The Australian government's already started to buy some diesel supply ships and bring that here at the spot price. So some of the most recent one I saw was a few days ago. The Australian government bid for a ship to bring diesel here at $2.70 a litre, and that was before getting on shore, before distribution costs. So if we keep having to do that and that becomes persistent, then that roughly $3 diesel price we're seeing at the pump, you could easily see that around $4.20. So we are looking at, again, very inflationary, even if we can get the supply here, and there's limits to how much we can do that as well. So we are going to continue to see a physical supply shock, we think, here over the next few months. The other logical question is there an end, or when does the end come? We have no idea. Frankly, it's very unclear. I don't think anyone suggesting that they do have an idea really knows. Trump's extended the deadline for a ceasefire 3 times now, with a pretty inflammatory tweet on Monday Australian time as well. So it's very unclear what the impact is going to be, what the duration of the conflict will be, and that means it's very hard to make any sort of portfolio decisions yet until we've got more clarity on how long that physical supply shock is going to go for. So some of the things that are giving us hope, we think there's 2 major constraints that Trump has, which he might not give weight to, but constraints are a better way to try and predict a political outcome than looking at what the incentives are. The 2 big constraints are US fiscal position. So the market, month after month over the last few years, has gotten more and more nervous about the very large levels of US fiscal debt and how quickly it's growing. the war costs a lot of money. We think that's a meaningful constraint for the Trump administration. And the other one is the midterms. So Trump's base in the last few months has really started to turn against him, and this war has only made that worse. And his tweet over the weekend has only made that worse again on Monday Australian time. So that hopefully constrains how much further we can go, but it's really unclear what that looks like. The other thing the negative here is that even after Trump's tweet, Iran and Iran-linked embassies around the world mocked that tweet back. So there was one Iranian embassy that tweeted, "We've lost the keys to the Strait." So it's not clear, even if the US stops the bombing campaigns and leaves the region, that the Strait reopens. Iran might keep it closed, knowing that they can just continue to inflict pain on their adversaries and US-linked allies. So that's very, very hard to make a clear decision from a portfolio perspective. So we haven't made many changes specific to the war yet across portfolios. We're waiting to see we're waiting to get better insight on longevity. If this goes for another couple of weeks, it's likely that the impacts will last for at least 6 to 12 months, even if the war stops at that 2-week mark. And then we can make clearer decisions about, with a 6 to 12 month view, inflation is going to spike, interest rates will spike, what are we going to do with portfolios? We've been trusting in our underlying managers. So most of our portfolios rely on active management across the fund managers. They're making active decisions in relation to the war, and so we're trusting in that. We're having regular contact with them to make sure we understand what decisions they're making and how they're thinking about it, because we don't want to double down on a decision. If a fund manager's already repositioned their portfolio, we don't want to make any assumptions that they haven't and make a change at our level. The other conversation we've had with advisors is where clients have elevated cash levels, because we think there's enough constraints to reduce the longevity of the conflict. We think it's a prudent time to deploy some of that cash. So if you've got clients with 10-15% cash where you'd normally hold 5% and you're waiting for a time to deploy, we think now makes sense to at least deploy some of that cash back into markets while they're off 10-15%.
Pretty good summary, Jordan. There was a couple of questions I had written down, but you answered them all for me. So I think everyone agrees they've just got to find some sort of solution. What that is, I think Trump's going to have to take a bit of a hit to the ego. And even if they stop now, as you mentioned, this is going to continue on 6-12 months with the destroyed infrastructure and supply chains getting back on track.
Yeah.
Definitely take your point about the active managers that we have in there, and they're allowing those guys to position their portfolios ongoing. It was something Chris brought up at the conference as well. And going into, you brought it up at the conference. Sorry, mate. That you'd sort of mentioned that, these active managers that we employ, they're there because they do a good job and they're actively positioning their portfolios to take advantage of this. Gold, I guess we do have some significant holdings in gold that's gone very well over the last 4 years. Gold is off about 15% off when Trumpy started dropping his bombs. Mm-hmm. Is that mainly just due to both investors and countries liquidating holdings to free it up in times of need, or is there other things that play in the short term there?
I'd say so. I'd say that's probably the biggest reason, and the other one would be the demand for pretty much investing in any asset in an environment this uncertain comes off a little bit. So you've had that dual effect of demand softening a little bit while sellers have ramped up to try and liquidate exposure, given it's probably one of their best performing assets over the last 12, 18 months,
Correct.
2 years.
Taking some profits, yep.
Yeah, but long-term drivers of gold we still think are quite strong and intact. This war doesn't change any of that.
No, correct. That US debt is one of the primary reasons, and then obviously we're going to start seeing inflation. All the reasons that we initially added it 4 years ago come back into play immediately.
Yeah,
Not that they've gone away, so we're still comfortable with that for the medium to long-term hold.
Yeah.
I guess one of the portfolios, just looking at the portfolios now, one change that we've recently made was in the strategic fixed interest, and I'll just mention on that. In that portfolio, you mentioned we could see some inflation. We went into this conflict with probably about a third of the portfolio exposed to longer duration. And as you mentioned, a lot of these managers in there are managing that duration down as we speak and around that conflict. The main change that we've made in there is we exited the JCB Global Alpha fund, and we've added a little bit more to the M Squared investment. We caught up with Paul Mirren, who runs that, when we were at the conference, just to double check everything was being managed as we expected, and it was. We're pretty comfortable with that, so we've added an extra 5% into that in the strategic fixed interest, and they're paying about 7.75% at the moment. JCB has been a little bit disappointing on the returns of late, so we've just made that change. And the other one we added was Colchester Emerging Bonds Fund, so that's been added into the portfolio in the last week. The other investments, we are keeping an eye on those, and we'll be completing some attribution since the conflict and for the last quarter this week, just to make sure everything's on track. And I think what we've seen play out as well in this last little bit, Jaden, is some of those non-correlated assets have helped to hold the portfolios up when the markets have taken this bit of a beating. The stuff that's not listed on the market has held up really well, and should hopefully give clients a little bit of comfort in these uncertain times.
Absolutely.
I'll probably just take a moment to mention the Explore to Hub transfer as well. That was put off middle of last month due to the volatility in the markets, with Explore kicking that can down the road to now take place on the 17th of April. And together with that comes up to a 1 month trade freeze. So while times might not be ideal for that, that's what Explore are going to impose on everybody. So one thing that we would make mention of again is that if clients are going to need cash over the next month that you're aware of, get in now in this next week to ensure that any transfers out of the MDA are done without any hassles while that trade freeze and everything is on. If you've got any questions on that, give myself or advisor services or someone a call, and we can give you a run through on what's happening there. Was there anything else that you had, Jaden, of note or interest?
All good from me.
Not a problem. Thanks very much for filling in for Chris. You've done a marvellous job. We might not invite him back.
Thanks, mate.
Right, if anyone has any questions, let us know.
Cheers.